In this market overview, I want to focus on the financial sector, which is one of the worst performing sectors in the market currently. This poor performance is one of the key ingredients to the overall market still being in a bear market. One of the main reasons that the financials have performed so poorly is loans made to oil and gas firms that are going bankrupt as the price of oil and gas remain low for an extended period of time. Looking at my stage analysis screening tool, you can see that the basic materials group has few components that have a large number of stocks in stage 2. And notably, the oil and gas sectors such as refining, pipelines, and oil and gas producers have very few stocks in stage 2, which tells you that these sectors are still trapped in a bear market. And if you look at the financials, you can see kind of the same thing. Some of the REITs are still performing pretty well, but moving down to like the banks, the money center banks only have 44% of stocks in stage 2. Regional banks aren't performing that well, and notably, foreign money center banks are performing horribly with only 10% of stocks in this group in stage 2. Now, looking at energy, we can see that energy producers are still trapped in a bear market. We can see each of these retests of the 30-week moving average has failed, and this sector is still underperforming the S&P 500. And there's no sign of this breaking out, or it needs to be the former stage 1 base and break above the 30-week moving average to end this bear market. The price of oil is in the same situation, which is driving the poor performance in the energy stocks. Even though the media likes to proclaim a bottom in oil every couple of days or so, there's really no end to this downtrend in oil at all right now. It's still underperforming the S&P 500, and even though it's retested the 30-week recently, it could easily go down and retest the lows or make a lower low. Now, this poor performance in energy has put a lot of pressure on the financials, as well as the economies around the world performing poorly and interest rates remaining low. So all these factors are contributing to this really, start of a bear market in the financials. And we can see that the XLF ETF has been retesting the 30-week moving average recently after this massive stock market rally since early February. But notably, the major indexes overall are above the 30-week moving average, but the financials are underperforming, and you can see that down here where the XLF is drastically underperforming the S&P 500. Now, if you look at the XLF performance from a longer term basis, you can see that whenever the financials tend to underperform the stock market, as can be viewed by this period from mid-2010 until late 2011, the financials performed poorly as well, but the overall market itself was performing poorly, which shows how important the financials are to overall stock market performance. So whenever you see the financials underperform the major indexes, it's a warning sign that if the banking sector isn't doing well, typically there's not a lot of growth, and there's loans defaulting in some area, which puts pressure on the rest of the market. And again, we can see this underperformance that's been starting since the start of this year, which has contributed to this new stage 4 downtrend in the financials. Now, usually the regional banks will go through periods where they will outperform the major banks, but you can see here that we didn't even get up to the 30-week moving average on this recent rally. So this regional banking ETF is really doing bad, and it's probably again the resumption of a stage 4 downtrend here. And now turning to um, some banks that have a lot of exposure to fracking loans, you can see that, like, I have a list of stocks that I've gathered from information on the internet, that banks that are more exposed to fracking than other banks. And this bank, for instance, you can see how it's was topping out for a long time in 2014 and 15. And once the market meltdown started last year, you can see how this bank just got hammered. I mean, it lost almost 50% from 72 all the way down to 44. So we had this big snapback rally, but notice again it failed at the key moving average levels, and is already way back below the key moving averages. Same thing with this bank, Cullen Frost. You can see again big stage 3 topping formation. Retest of the 30-week back late last year. Then the stage 4 really is in force, and a big collapse once again. And once again, one other stock, Comerica, same situation, stage 3 with a stage 4 commencing to start this year. Now, looking at foreign banks, these things are performing horribly as well, even worse than major U.S. banks. Barclays went into a stage 4 in the middle of last year, and it just has been collapsing underneath the 30-week moving average ever since. Deutsche Bank has been a huge underperformer ever since the start of 2014. So this was one of the first warning shots for the overall market, is how this bank started breaking down, because it's a major international bank. And you can see that every time it's retested these key moving averages, it keeps failing and resuming into a stage 4. And it's lost over 50% of its value now since early 2014. Looking at some of the major U.S. brokers, Morgan Stanley look at how poorly this performed on the big stock market bounce from February. I mean, this is a bad sign for the overall health of the market, that some of these major U.S. brokers are doing so horribly. It didn't even get anywhere close to the moving averages on this last bounce, and it's drastically underperforming the S&P 500. Goldman Sachs is in the same situation as Morgan Stanley. And looking at some of the big banks, J.P. Morgan broke down below the 30-week to start this year, and then this rally has been tepid at best, again remaining below the key moving averages. And one more thing to look at is the FAS ETF, which is the triple inverse to the financials. We can see that this ETF had monster volume. This is stage 2 breakout type volume to start this year, when the bank started collapsing. And then during the stock market rally, we've seen this ETF collapse back below the moving averages. But notice how it's kind of stayed at support right here, and right at this gap that formed on the chart when this broke out to start the year. And this is kind of really the final line in the sand for this to remain, have a chance at breaking into a new uptrend. So it's kind of supportive that we've seen this hold support, and this still could break back into a stage 2 if the banks keep collapsing. So to summarize, the financial sector is performing horribly, and it's really a bad sign for the stock market as a whole. And I don't expect the stock market to resume a bull market until this bear market in the financials comes to an end. To get more information on stage analysis, you can visit my website, and I've created a stage analysis screening tool at the following URL.